All right, hello everyone, and thank you for joining. And also thanks for everyone who joined yesterday during the live webinar. I wanted to record a cleaner version that I could send around to anybody that couldn't make it yesterday. So that's what we're doing here. What I want to show you today is how a simple Williams percent R idea became a more robust mean reversion framework through live trading, structured testing, and some refinement. So let's get straight into it. Aha, maybe not straight into it. First of all, we got to do the disclaimer, right? So you guys know the drill on this. We are not regulated. This is not investment advice. This is for educational use only. So consider yourselves disclaimed. Okay, so I want to say up front that the core ideas here are deliberately simple. That does not mean that they're unsophisticated. It's really just because these simple and robust ideas tend to survive the test of time and actual market conditions, rather than the things that are clever or at least sound clever, but then they end up being really fragile once it's in the real world, right? So I say this knowing that a bunch of you guys are maybe quants and engineers, and you're going to be very sort of detail oriented. And I know, because I'm the same way, that in trading, complexity often feels smart, but it doesn't really work when those market conditions change. So I tend to think about this drift towards complexity a bit like a meditation, right? When we are meditating, if you've ever done it, you tend to focus on something, usually like your breath or your breathing, something like that. Um, and then your mind's gonna get distracted and you're gonna kind of drift over here or drift over here. And you have to bring yourself back. You have to like notice and bring yourself back to the breath, right? And so complexity kind of works the same way. We start simple. That is the thing that we try to focus on. That's like the breath, but we're gonna have this tendency to go back towards complexity or here or this way. And we got to remember to just bring ourselves back towards simple, which of course, is mean reversion, which is what we're here talking about today, right? Okay, so why are you guys here talking to me? A quick one on me for anybody that doesn't know. My background is really basically kind of like this intersection between markets and systems and technology. I've been doing this for a long time, 25 plus years or so now, across basically fintech, trading. I did roles in Deloitte and UBS and Barcap, um, and I've basically been actively trading since 2007 or so across lots of asset classes. I got an MSTA qualification from the STA, that's the Society of Technical Analysts, based here in London, and I'm now one of the board members of the STA, and I'm the chair of its investment committee. I also founded or co-founded R Factory and the Systems Lab. So I'm here talking in my capacity as R Factory today. I have another company in the US called the Systems Lab, which runs or tends to focus on a trend following system. And today we're talking about a mean reverting system. I've also, over the years, had the opportunity to interview and learn from a bunch of amazing traders. So such as, Larry Williams. We're talking about Williams percent R. I got to speak to the man. It was great. But also Perry Kaufman, Tom Basso, John Bollinger, and his daughter Zoe, Jason Shapiro. And I've studied closely with Dr. Ken Long, and I've done a bunch of the Van Tharp work as well for you guys who know the Institute out in North Carolina. So all of this has influenced the way that I think about markets and systems and design and robustness and all of that. So I guess really what I'm saying is the lens that I bring here is more than just, theoretical. It's practical system development, trading experience, and evidence-based evaluation. All right, so just in case people don't know, let's cover mean reversion. What is it and all that. In general, markets tend to either trend or go sideways. And the reality is they tend to go sideways more often than they trend. So this on the slide here is just like a really simple version of the idea. It's also the best possible case idea, which isn't real. But imagine you've got price and it's just oscillating in a channel. It goes down to the bottom of the channel, you buy. it moves back towards the middle, maybe a bit more, you sell or you exit. And so that is like mean reversion in the perfect world, right? We've got this sideways thing and we're going to like get the extremes and pull it back to the middle. And maybe you also take the short side at the top and trade it back the other way as well. And here, what I'm showing you today is going to be a long only system just because it's a bit simpler, but realistically, we might as well be able to go both sides. But of course, the real world is a lot messier, and it does not look like what I'm showing you here today. All right, so what is the problem with that? It all seems great, aside from it being a bit messier in the real world, right? But most traders do not really have a mean reversion system. They tend to find some sort of mean reversion trigger or an entry idea, and then they see something which looks oversold and they buy it, and then they kind of hope for it to snap back, and then they want to do something like sell at some point. Should it be at the mean? Should it be higher? Should it go for the moon? Ultimately it tends not to be enough. And also we got to kind of pay attention to some of the market regimes, and well, think about how we're actually going to do those exits, right? So these are the things that are often tripping people up. So let's cover Williams percent R, the actual indicator, right? So again, I kind of said Larry Williams was the guy that pulled this together in the first place. And at its simplest, really, it's just telling you where price is relative to its recent range. And so if you've got a look back of 10 bars, 20 bars, whatever it might be, we're trying to figure out where is the current closing price within that range. And then it's kind of like a percentage. Sometimes they flip it upside down. Speaking of which, there's a whole bunch of oscillators. This indicator falls under a class of indicators called oscillators, which tend to oscillate up and down, and usually it's underneath the chart like it is here. And most of them kind of behave the same. And in fact, the Williams percent R, once you start getting into the weeds of it, is kind of like an upside down stochastic. But really all we care about is that you end up in these overbought zones or in these oversold zones. So like the extremes that we talked about around mean reversion, right? So that's all well and good. It can be a bit messy, and it can stay overbought or oversold for long periods of time. However, with a couple like little refinements, there's a lot more information available there that we can maybe start to take advantage of. So let me just give you like a little breakdown of the lineage of this whole idea. So I mentioned Larry Williams, right? There he is. His original idea, but then Dr. Ken Long, who I know very well, he had his own refinement to this idea, which he called the NDX indicator. And then I kind of used that and also built my own sort of extension off of that, which just kind of unveils this bit of extra information. So building off of this strong base concept, but pushing it towards something a bit more, and also something that can give us some actual signaling out of this. So like a structured exhaustion signal. So let's talk a little bit about how we can enhance that indicator. There's more information in the indicator than we're actually making use of. And this actually goes for most indicators, certainly most oscillators, especially if there's only like one line. Because, if we're thinking about price, we rarely kind of look at a line chart unless it's something, I don't know, like on a presentation or television or something. If we're looking at it to trade or to make decisions off of, we're usually looking at bars or candles or something, right? So that shows us more than just the closing price. It's showing us what the high and the low was for the day and the open and the close. So why don't we make any use of that in an indicator? There's a bit more information that we could find in the indicator itself. So, the indicator, if we get back to it as well, that's not the actual edge. The value really kind of comes from how we frame the indicator inside of some structure, some context, a trading framework, and some risk handling around the whole thing. So the indicator is just part of the story. So here's an idea of taking that line chart on the indicator and trying to get some more information from it. Let me just go back where we were before a second ago. Here's the line chart on the indicator. You can kind of see it going up and down, and we've got some red bits at the top and some teal bits at the bottom. But if we enable more data for what's actually happened during the bar, then we get like a high and a low out of the indicator, and we also get that closing price, which is like what we just connect the dots on with the line chart. So basically here, we're just trying to take advantage of the extra information that is available there. Okay, so what do we need when we're making a trading system out of this sort of thing? There's three main things that I'm focusing on here. We call them three pillars. So we need signal quality, and we're going to get that from using, some of the extra information we just looked at, some more evidence of exhaustion, not just like a stretched reading on the indicator. And then we need the right market environment for this, because some of these regimes are going to be hostile towards mean reversion. If we're in a really strong trending environment that could be up or down, it's really not going to work out that well if we're trying to trade this sideways thing, or this thing that we think, this market we think is sideways. So we want the market environment to fit right. And then also we're going to need some exit logic that A, makes sense, and B, preserves some of the edge that we're getting from our entry signal. We can either give it all back, or we can try to take a short, like a small amount of profit target, and just not make enough to make up for losses. So I created a mean reversion system with these three pillars in mind. I'm going to talk you through some of that here. Here's how I approach this whole idea. I'll kind of walk you back a little bit in time. So mainly three phases. This may seem sort of out of order or in a strange order, but to me it makes a bit of sense, and I'll talk you through it. So phase one, core idea, which is based on intraday ES futures. It was long only, just makes things simpler to kind of get going on. This was back in December 2023. I was participating in a Tortoise Capital research event, and I came up with this idea following the lineage that we talked through a minute ago, and then wrapped a system around it, and everything looked pretty good. You can see from the equity curve there underneath phase one, it was like, okay, this is actually working out pretty well. That's about a year's worth of data, I think. And this is trading intraday, so intraday ES futures. Now, after the research weekend and doing all of this work, I decided that this was actually looking pretty good. I was aware that I hadn't done a full-on multi-year back test on it and tried to optimize everything. I just did a little bit and then figured out what made sense logically to me. And then it was good enough to just say, okay, you know what? We're going to go straight into the next phase, which is prototype testing live on live markets. So if you've not heard of prototype testing before, I've got this idea from Ken Long. The real idea is we want to get this thing live, and we want to do it on small size. So a size that doesn't really make too much, not a huge impact to us. It could be the smallest size you can, or it could just be a portion of what you might be wanting to trade once you go to full size. So I'm talking about position size here. We just want to keep it small so that we're not trading an awful lot of money here. So for this one, basically straight after the research weekend in about January, I put this thing live and just did it on the MES futures, so the micro ES futures, which were available at the time, and very similar to ES. And they become more and more popular and liquid these days. So these are heavily traded instruments now. And then I let this run for 2 years. Now, I hear you say, why would you do that for so long if A, it might be looking okay, and B, you could just do something more with it or whatever. It seems like a long time, right? And, in all honesty, we were just kind of busy doing lots of other things. And I just let this thing run in the background, kept my eye on it, and thought, okay, this is actually looking like it's got some promise. So recently, we dug into this, and realized that, okay, well, it's not blowing the doors off, but it's positive after all of its costs. So after slippage and commissions, all of the known shortcomings, and running this thing live, you just figure out things that you didn't know, right? So the beauty of prototype testing is just figuring out the what do they call them? The unknown unknowns. The things you just aren't aware of that trip you up. But this worked out pretty well, and so everything built in. There were some known shortcomings that I was aware of the system itself at the time, but this is proving to me that there's gold in this mine, another Ken Long saying. There's gold there. So we can dig in a little bit deeper and figure out how to make the most of this. So that brought us into phase 3. So phase 3 was basically going into deeper research mode. So systemized, structured, doing a whole bunch of back testing over a longer period of time. So 6 years, and then aiming to sort of stabilize on those 3 pillars we talked about, and also run some like out of sample forward validation on this as well. So a little bit deeper into that research process. I don't want to drown you in tables because there was a lot here. So I'm going to try to give you just a high level overview. So the core signal idea, the essentially entry exhaustion signal, had basically proved itself. So we were focused on the other 2 pillars. So if you remember, those were the exits and the regime filters. So this was not like a 1 or 2 backtest thing. We ran over 100 here. And along with some final out of sample validation, like I said before. So the point is not that one run looked good and we're like, wow, that's the best one, let's go for it. It's the fact that the idea basically survived being challenged from lots of different angles and lots of different ways. And really what we're trying to do is find the environments in which this thing should perform at its best. So like I said, 2 things here. The exit side, and there's lots of different exits tested, and then the regime filter side, like what market environment is this thing going to work with best, both intraday and also maybe like a higher time frame, like a daily market environment, to see where are we in the bigger picture. So we tested out all kinds of stuff here. Here's what we found. The concept itself was not the main weakness. The bigger issue was preserving the edge that we were getting through proper exits and that whole regime selection thing. So that is useful for not just the system, but for basically systematic trading in general. So also what was interesting is that some of the sort of like intuitive things that you might think of to preserve profit, to just to trail a stop or ratchet, tended to make it worse. In fact, I'm pretty sure it always made it worse. And that's different than it might be in a trend following environment, for example, where you can sort of safely get away with protecting your profits with some sort of break even stop or trailing your stop up because the market is moving in your favor. When we're in a choppy sideways environment, it just doesn't really work. We got to basically kind of get in and look for our profit targets to be met. And really it comes down to sort of sizing or right sizing that profit target, I should say. Also just selectivity about like what sort of regime are we in. And yeah, that was the main sort of learnings, at least at the high level there. So I want to talk to you about how you can take this further. We basically, at this point, I hope you can kind of see that this is not really a story about an indicator. It's a story about how a simple idea can be refined, tested, and then turned into a more robust trading framework. So what I've shown you here today, I hope anyway, is the top layer, like just the tip of the iceberg in a way. The logic, the structure, the key lessons from the research that we did. But right from the start, people were interested in learning more. Like when I first sort of delivered this research a couple of years back, people wanted to know more, and so we created a wait list for a course that we were thinking about putting together. And I'm pleased to say that that course is now available. So what that course gives you is everything underneath the top of that layer. So like the full framework, the exact implementation that we're using, and more than that, like the complete path from concept through to execution. So you can follow along the whole research journey along the way. And it doesn't mean that everything's going to work out swimmingly well, but it's going to be a realistic representation and also give you a couple sort of off ramps for your own selective reasoning for what would work best for you as a trader. Sometimes the things that perform the best are actually really difficult to trade. So automation can help us with that to an extent, but if it's something that you really kind of jar with, you'll eventually turn the system off or stop trusting it. And so we need to work with what's going to fit with us and our personal taste as traders. So if this idea fits well with how you think and work, then and you want to take this a bit further, then the course is going to be your next natural step from that. Just a little quick bit about what is in the course and what it covers. We basically have the full mean reversion framework. We've got all the details of the indicators and how they're calculated, how they're formed, that full journey from how we got to the exhaustion signals, along with the whole system logic, the design process, and the whole research journey from doing all of the testing all the way through and all of that robustness work. It also gives you a practical implementation path for if you want to take this forward for yourself. So all of that is baked in. Now we've got 3 modules, there's 6 in total. The first 3 are out and ready to go right now. Module number 4 should be dropping in the next couple days, I think. And then 5 and 6 are the last couple. They're going to come over the next couple of weeks. So the course covers the framework, the logic, the research journey, the implementation path, all of that. And really it's designed for traders who sort of want to understand what they're trading, right? And, I'll put this a little bit more clear here, like who is this course sort of designed for? It's not really explicitly designed for people who are looking for like a magic black box that they can just kind of flick on or off. It's for traders who want to understand the logic, the research, and the implementation path. So if that's how you like to work, then this is going to be a good fit. Even saying that though, if you are looking for a magic sort of black box, it's not quite a magic black box, but we are going to be offering some custom software that we've built for TradingView, and that's going to allow you to see all of the modified indicators and the system baked into that as well. So there's back testing availability, and then even all the way up to some automation if you want to go that far. And we've got an early access offer. So a few weeks ago, we finally opened this up to the wait list who were, we wanted to reward them for their patience, for sticking with us for a couple of years while we got around to going through and doing all of this work. And so we gave them a substantial discount for their patience. And we thought, you know what, we're going to extend that off to you guys as well. So the normal course price is going to be $14.95. That's US dollars. But we're going to be offering it at $500 off. So $995 is the early access price. So we think that's really reasonable for the amount of work and learnings that are in here. So if this fits how you think and how you trade, then the course is open and available now, and it's the best time to join. Okay, so really just a final slide here, guys, just on how to sign up. And originally this was for any questions on the webinar. But what I've shown you here today is really an overview. And I think we've given a pretty good overview of how this whole thing works, along with the reasoning. And if you are interested in the full framework and implementation path, the course is going to give you all of that. So if that fits your style and your trading, now is going to be the best time to join. It's never going to be cheaper than what we're doing here at the moment. So you've got until Monday to take advantage of that early access price of $995. There's a code on the screen there. So G9R7VK is a coupon code. You can plug that in. There will probably be some links available. You can just click and it'll bring you straight in as well, or just go to the R Factory website and plug in that code. So I hope it's been a useful session for you and you've learned something. Thank you so much for your attention, and I hope to see you in the course. See you later.